If growth stocks or tech companies have higher expected growth rates, why wouldn't we just put all of our money into those? Doesn't it seem obvious that buying the fastest growing stocks would make for the best investment portfolio? Spoiler alert, the answer is no. I'm going to explain why that logic can actually get you into trouble. That there's actually a missing piece from that equation. Even if you were able to predict which company would grow the fastest out of all the other companies, that still wouldn't guarantee it's a good investment. Let's talk about why. So to understand this, we're going to need to dive into a little bit of a nerdy topic, something called the price to earnings ratio. But it's not as scary as it sounds. Basically, it's just comparing the price you're paying for a company against the amount of earnings that the company is producing. This is a useful tool for comparing different companies, right? Because you can say, how expensive is it for me to buy $1 worth of earnings at these different companies? Let me explain it with kind of an analogy. Imagine that you were able to buy a little printer that printed a perfect $1 bill, and it takes 1 year for it to print, right? So it's generating $1 per year. The question is, how much do you have to pay for that printer? How much does the printer cost? If the printer is $10 and you are getting $1 back from the printer every year, then that price to earnings ratio is 10. But instead, if you have to pay $15 for the printer, then the price to earnings ratio is 15. If you have to spend $20 for the printer, then the price to earnings ratio is 20. So you can see how, if everything else is equal, you would want to buy the cheapest printer that you can. You would want to spend as little as possible to get the printer that pops out $1 per year for you. Because no matter which of those printers you buy, you're getting $1 per year back. So if you can buy the printer for $10 instead of the one for $20, you're essentially getting twice as much of a return from the cheaper printer. So this is why analysts will use things like the price to earnings ratio to compare different companies, because you're seeing how expensive the company is relative to the amount of earnings that it is producing for you. But investing isn't quite that simple. If it were, people would just go out and buy the stocks with the cheapest price to earnings ratio, and they would always outperform the market. But it's not that simple. Because imagine that there are two stocks and they both have exactly the same price to earnings ratio. Say they're both 15. This company over here is a mature, stable company. Let's say it's like a bank. And it has already grown basically as much as you would expect a bank to grow. It's nationwide. There are branches in every city across the country. And it's earning stable profits, but you don't expect it to grow very much, right? It's just kind of a good, steady company. But say this company over here also has a price to earnings ratio of 15, but it is a brand new tech startup. And it's been inventing new things that are kind of revolutionizing different industries. And you think it's possible that this company could continue to expand and grow and do things that change the world. Well, I think most people, when looking at these two companies, would see that you probably would prefer the company that has some growth potential, right? This company over here, probably a good company to own, but you don't think it's going to grow very much. This company, if you can buy it for essentially the same price, the same price relative to its earnings, but it has the potential to grow by 10 or 20 or 30 times what it's currently at, seems like this would make a lot of sense to buy this one, right? And that's what happens in practice. If people see these two companies side by side, they'll buy the one with growth potential. So what does that do? Well, that actually drives up the price of this stock over time. And when the price increases, that also changes the price to earnings ratio, because price is half that equation, right? So let's say these both started with a price to earnings ratio of 15, but the price of this one gets pushed up, so it's double. So now instead of 15, the price to earnings ratio is 30. The price to earnings ratio of this stock is now higher because people are pricing in those growth expectations, the potential for this company to grow a lot more than this one. So this is really why picking individual stocks is so hard, because it's not just as simple as saying this company is a good company, this company is a bad company, or even saying I think this company has growth potential and this one doesn't. some of that growth is already baked into the price of this one. And so you have to pay more based on those expectations. And that spread between the two different price to earnings ratios, between how much you have to pay for these two companies based on their expected growth rates, kind of ends up evening the playing field a little bit, right? Where you don't know in advance which one is going to work out better for you. You see, if you're just looking at growth rates, there's a missing part of the equation, which is the price that you are paying for it. If you pay too much for any investment, regardless of how fast it grows, it might never grow enough to offset how much you overpaid for it. And the opposite is also true. Even if a company doesn't really grow very much, it just sits there making profits for you. If you got it at a really good price, you might be just making tons of money on that deal. The key takeaway that I want you to always have in the front of your mind is that expectations are already baked in. I'm not saying the expectations are necessarily correct, but the market as a whole already knows how fast the company is growing. It's getting the same kind of annual financial reports that you are. And there are all these other traders and analysts who are out there looking at that. And if there is a company that's undervalued, people will buy it up to the point where it's no longer undervalued. And if there are companies that are overvalued, people will sell their shares until it's no longer overvalued. I'm not saying it's impossible to find stocks that are incorrectly priced, but it's extremely difficult, which is why I don't recommend trying to buy individual stocks. And I don't recommend making really concentrated bets in specific categories like growth stocks or tech stocks. Because say you're looking at tech stocks, even if you are right that some new technology is going to change the world, like I said, it's not enough. Are you able to get that stock at a good price? Or is the expectation of that company changing the world already baked in? Or is it already overhyped? Are there too many people who believe it's going to change the world and they're willing to pay too much for it? That might make it a terrible investment. And the more you're trying to make guesses about which companies will be the winners or which categories of stocks will outperform, the closer you get to gambling, the closer you get to just making guesses about the future and rolling the dice. We want to set up financial systems that are more rules-based and self-correcting so that we can invest with confidence for the next 30 or 40 years. This is why I recommend your portfolio be based on a solid foundation of broadly diversified index funds. So that as a whole, your portfolio is not trying to play those games, not trying to make those guesses. If there is something that you really believe in that you want to bet on, I mean, that's fine, but do it with a small portion of your portfolio, not the whole thing. You want to make sure you have a firm foundation first before you start gambling. So, why did we spend all this time talking about such a pretty nerdy topic? Well, core takeaway is that a great company isn't automatically a great investment. A great company isn't automatically a great investment. It depends on the price you pay for it. I'll be honest, if all you take away from this video is to not gamble on individual stocks, I will consider that a win, but I hope it helps. And if you do have any other money questions, please send me an email. Please consider subscribing so you see other future videos like this. And let me know if you want future videos to be more nerdy or less nerdy. We can really get that dialed in. But for now, thanks for watching, and I hope you have a great day.